Directly from 42nd Street in Midtown Manhattan, New York, I am your host Harbin and you're watching my channel YOLO, You Only Live Once. Let's talk about today's topic, how to buy treasury bills and treasury bonds in a secondary market from your brokerage account. uh, why don't we buy just from Treasury Direct? Yeah, you can do that. I also do sometimes, especially when I am buying I bonds and E bonds, because you can't buy those actually with the brokerage firms. But I sometimes do buy Treasury bills and Treasury bonds directly with the Treasury Direct also. But we need to take into account that Treasury only sell treasury bills in 4, 8, 13, 17, and 26 weeks. So that means if you are looking for a treasury bill which is around suppose 20 weeks or around 30 weeks or maybe 40 weeks, there's no way for you to actually buy it from the treasury directly. So uh, the three types of securities you're buying from Treasury directly are actually only for those particular length of time. So if you want to basically buy, suppose, a treasury a note for 4 years, there is no way for you to buy it from Treasury Direct, or 6 years, or 8 years, or 9 years. Okay. So what you want to do is basically you go to that your brokerage account and you buy on the secondary market, because you can time it according to your time frame requirement when you're creating the laddering of treasury bills, treasury notes, or treasury bonds. So let's visit today and find out how we can do that with brokerage. I'll actually go through three different brokerage account I have with Merrill Lynch, which is a brokerage arm of Bank of America, Charles Schwab, and Fidelity.
So this is Merrill, a Bank of America company. So it's basically backed by Bank of America. Uh, so I've been trading with Merrill for like almost 30 years. So I really like their like they were the first one to basically give zero fee or $0 trades. And now almost everyone basically gives you $0 trades. But this was actually a big thing. Fidelity actually never did that. So I always actually have used Merrill in the past for my stock and also bond purchases. So if you look, you can actually go to the overview. So what you need to do is in the trade, you go to fixed income, and then in the fixed income, you can actually go to the overview. Uh, I can actually go that route, so should be okay. So in the fixed income, if you know the QSIP ID, you can actually go to a particular bond, but we want to do fixed income scanner because we don't know which one we want to use. So let's first look at the overview so that we can compare across all the brokerage firms. So in the overview, you will see that, okay, the bonds are listed and their current rates, what are being offered. So the treasury is 4.66, 3 years, 1 year is 4.66, 3 year 4.157. And if you look at from 1 year to 30, like 10 year, it has gone down and then it has gone up a little bit. So what does that indicate? That indicates that the interest rate in the short term might actually go up, but in a 5 to 10 year terms, the interest rate will be actually going back down. So that's where the market is heading. So that means in the next 1 year, the chances of rates to go up are still there. But in the long run, the chances are that, okay, the interest rate will actually stable and will go down. But the 20 and 30 years shows that, okay, there's still chances for long-term rates to go up in the near future. And if you look between the treasury and municipals, the municipals are certainly tends to be lower in the short term, but higher in the long term because the risk factor. The risk factor between treasury and municipal is that treasury are the lowest risk bonds, followed by municipal to some extent, and then corporates. So that's why the corporate rates are much higher than the treasury. And the agencies are also higher. See, the higher the risk, the higher the interest with respect to treasury. Then you look at the CDs, they are FDIC insured CDs. If they are not, they will actually let you know. The difference between callable and non-callable is that if you see a higher interest in a callable than non-callable, and that is due to that if the interest rate drop drastically, the issuer has a right to call and then give you back your money without continuing with the CD. So there's a risk of loss of long-term interest if you're going for a long-term callable. So never go for a long-term callable. Should if we are looking to lock in an interest, then you should go for a non-callable CDs. So let's look at how this basically works out with respect to other brokerage. So this is Charles Schwab. So the Charles Schwab, again, you do the same thing. You go to the trade and then you go to bonds. Then you actually see and there's that, okay, overview, the CDs you have starting from 4.47 and all the way to basically it's going to max of 4.83 and then it goes down. And for 10 year, it's giving you 4.80. But if you look at 4.80, that you'll find that most of them are callable. Okay. So there's no point actually going for 4.80 10 years that, okay, if the interest rate goes down after 2 years to 2%, they will call. Even for 3% or 3.5, they can call. So there is no security that, okay, you will get that interest. So for a that long duration. So don't go for a callable, in my view. Should not go for a callable CDs. Now there is a US Treasury rates here. Again, it goes up to 4.69 for 6 months, and then it's going down steadily till 10 years. But then for 20 years, it's coming up, but 30 years, it's not. And the difference between US Treasury and zeros, the euros or the strip version where they have stripped the coupon rate and then you just get the skeleton treasury bond. The benefit of holding treasury zeros that, okay, they are discounted much deeply, so you can buy more for a long term, but don't hold it in your taxable account because even though you won't be getting any tax interest, you will have to pay the tax on the interest. So it's unnecessarily out of pocket expense to just keep that treasury zeros in your portfolio. So it's not a good idea, but it's a very good idea for retirement accounts because you're not actually going to pay taxes on a yearly basis. So let's compare now to the Fidelity. Fidelity also has a similar thing. You go to the trade, and then in the trade, you can actually select fixed income. And so you can actually search inventory. So here again, you get the same overview. So the CDs, you can see that, okay, again, 10 year is 4.80, and then the user treasuries are similar and zeros are similar. Okay. The Fidelity and Charles Schwab look much similar than the Merrill Lynch or Merrill Edge. And it seems like maybe the CDs might be the same also, you never know. So Jonesboro State Bank. So it is going to be the same as, yeah. So it's Boro State Bank. So it's exactly the same. So it seems like the Fidelity and Charles Schwab more or less have a similar software. They are seems like exactly same thing, but Merrill Edge seems like a different uh, altogether. So they have a callable separate from non-callable, and they don't have 4.80 10 years. So let's say non-callable. So it's 3.75%. So they only have a 3.75, which is a Beal Bank. Okay, so this is still better. You have a fixed 3.75 secured rate for 10 years, and that's actually much better than having a callable rate. But see, the rate is much higher, 4.80, so that sometimes become very tempting. Uh, so similarly, look at the treasuries. 20-year is 4.11 and 30-year is 4.12. So this is actually a very good. So you go to the overview and now basically see what are you looking for. If you're looking for 1 year treasury bill, so you click on this. So you'll get this thing sorted. So I always sort them on the basis of yield to worst or yield to maturity. Okay, so the difference between yield to worst and yield to maturity is that if there is something that is callable or something where the it can be taken away before the mature date, then your yield tends to become different from what you will get at maturity. But in most cases, like this remains same. And but if you have to actually look for, you should look for yield to worst, so that you know what is your worst case scenario. So in this case, you can see coupon rate is zero. When the coupon rate is zero, these are all treasury bills, so the coupon rate is always zero. So you actually get discounted treasury bills, and you get the whole lump sum. So the actual standard par value is 100, and you actually buy it at uh, discount, so that you end up basically getting the full value when you surrender, and that will be the difference between the two is actually your interest. So you can see that, okay, you have starting from June on 2023, and this is November of 2023. So if you have to go for a long term, you can see that, okay, uh, 6 months is 4.64, but 11 month is actually going to be 4.628. Why it's not a bad? If I've been choosing, if I want to actually have a 1 year treasury, I'll actually go for this one. Okay, so you go to screener. Suppose I'm basically looking for a time frame. So I'm looking for a 3 to 5 years, okay, time frame. So I actually click 3 to 5 years, let's say apply, and you actually see all 3 to 5 years. So you can actually then do it on maturity date, okay. So that means this will basically giving you 5 years, and then you can see out of these 5 years, which one has the highest interest. So 3.875 is the highest you're getting for November 15th, 2027. It's also a strips. So now you want to say that, do I want a strips or do I want this thing? So think of this way. Okay, this is 3.875 and this is 3.791 and this is 3.828 and this is 3.816. Okay, so now if I'm basically trying to hold it in my retirement account, I'll go for strips. I'm getting the highest rate. I'm not obligated to pay taxes on this every year, so I'll actually just go for this. But if I'm going for a taxable account, I will not go for this because even though I'm not getting any interest on that, I have to be pay taxes on the 3.85%, 75% interest that will actually be due. So that's the issue. And between the four of these, basically, which are having a coupon rate, in my view, the best thing is to go for the maximum coupon rate. So see, this is 3.816 and this is the 828. I'm getting less interest here, but the coupon rate is higher. So the benefit of that is that if the interest rate go down, this might actually get you more value than this one. Sometimes it doesn't matter, okay, because this is 3.791. But see, if this is 3.791 with a lower coupon rate, there's no brainer that, okay, I'll go for 3.816. I have got a higher yield as well as higher coupon rate. But between these two, you have to basically see if you're going to hold it for maturity, so it might make sense to actually get this 12 points more rate than the coupon rate. Okay, so in case of Charles Schwab, also you basically click which one. So they have yield to maturity. They don't have, because in most cases, as I said, these two values should be same. It's only case of a callable you have a yield to worse and yield to maturity difference, or in other cases also there might be, but in case of a treasury bonds, generally it remains same. So you can see that you have 3.683 and you have this. Oh, okay. So this 1.455 is there because it's basically coupon is 0.625 and yield to maturity is 1.455, but it is inflation protected security. I'm not big fan of tips, so I'll prefer basically you have a standard locked interest if you're going for a treasury bonds. That way you know how much you're going to get for the rest of the period. So Charles Schwab has this CD and treasury ladder builder, so you can actually create your treasury laddering using this count. And you have a 1 year CD ladder. So you have four rungs basically. So you'll get 3 months, 6 months, 9 months, and 1 year. And they're showing that, okay, you're getting 4.47, 4.65, 7.3, and 6.5. 2 years CD ladder. So you will get 6 months, 1 year, and 2 year. But you can actually have 6 months, 1 year, 18 months, and 4.5 years. And on the 5 year CD ladder, you have 1, 2, 3, 4, 5 year CD ladders, and you can actually go and continue doing that. Or you can create your custom ladders. So similarly, 1 year treasury ladders, you will get 3, 6, 9, 1 month, and you can have 2 year treasury ladders. You have 5 years, or you can actually create your custom ladders. So the benefit of laddering is that you are safeguarding your interest with increasing interest rate. So if the interest rates are increasing over the next 4 or 5 years, you'll be able to actually be able to take the benefit of that as and when your CDs or treasury or CDs are maturing, you actually go for next 5 year, and then the ladder remain in that fashion. So let's see how Fidelity actually has anything different. So if we basically click on this 3.835 years, so you get all these treasuries available to you. Again, that okay, so they have yield to worst and yield to maturity. Let's see basically if there is any difference. Let's see for bonds, all of them are actually having the same yield to worst and yield to maturity. So you can actually compare See, all are higher or zero coupon. So again, the rule remains same that okay, if you are going for strips or zero coupon, do it in your retirement accounts or tax deferred accounts. And if you're building it in your taxable account, go for a coupon rate. Uh, in normal sense, generally the rule of the thumb is that okay, the higher the coupon rates, the better. But if you're interested in actually having the best yield to maturity, then concentrate on just best yield to maturity. If your goal is to basically keep the bond for that period, it's always better to go for highest yield to maturity or yield to worst. So that's how you basically buy it. It's buying in a secondary market is actually very easy. It takes out the stress of like if you're buying directly, you actually don't know what interest you will get. It depends on like okay, the market. You don't control the higher the institution those buys in bulk control the rate, and they actually they specify what rate they want, and then that's how the rate is calculated. But in the secondary market, you know exactly what you are buying and what is the rate, so you buy for that yield to maturity or yield to worst. So uh, if you looked at my videos, how I built the treasury laddering in my taxable and retirement account, you will find that okay, most of them are built in a secondary market. So if you are basically interested in buying bonds and treasury like bills ladder, it's very easy to actually do it in any of your brokerage account. It should be, as you can see, across these three brokers, things are similar. There's everything is similar, so you know that okay, with your broker also, it will remain same. If you have any comments, please leave it. Subscribe to my channel, like the video, and certainly leave a comment